Welcome back, my friends. Today we will talk about inflation, increased interest rates, and which type of stocks going to benefit from it. Since the outbreak of COVID last year, millions of new securities accounts have been opened across the United States. Many people start trading stocks for the first time. As of April this year, stocks account for 41% of the financial assets of American households and set a record. Since so much money has been invested in the stock market, Treasury Secretary Yellen recently stated she believes that the United States may need to raise interest rates to prevent economic overheating during the recovery from the pandemic. Later, although she stated the low interest rate environment may continue for a period of time, it was not a proposal to raise interest rates. But this news obviously provokes the nervous market to fall. I believe most people already know this news, but there is a question here. Raising interest rates is a matter for the Federal Reserve. The Federal Reserve, as the central bank of the United States, decides whether to raise interest rates and when to raise them. And the United States Treasury Department is a part of the United States government, mainly responsible for the issuance of bonds for international financial transactions. The Fed usually raises interest rates in an attempt to reduce QE and receive a lot of financial loans in the United States. It can be seen that although the Fed's QE is huge, the growth rate of the United States commercial bank sector during the same period is less than 10%. The other parts of QE went directly to the hands of the people. Mostly of it went to the asset sector, such as the stock market, real estate market, and the currency market, etc. So what is the purpose of the Yellen saying this? The first guess may be that Yellen and Powell discussed it. Let's test the market's response of interest rate hikes. This is a preview of Powell's future talks about interest rate hikes. When Powell talked about how to control inflation, he said he will raise interest rates. Powell said we will consider raising interest rates after inflation and employment reaching the target, and before that, the QE was reduced first. On May 1st, so that the United States consumer spending increased by 4.2% in March. The core consumer price index in March rose by 1.8% from the same period last year, the largest year-over-year increase since February 2020. Some economists began to call on the Fed to start discussing reductions as soon as possible. This refers to the Fed's monthly purchase of $120 billion in assets. Biden recently announced a new vaccination target. 70% of American adults complete the first injection before the July 4th Independence Day holiday. This is now about 1/3 of the vaccination rate. Secondly, Canada is the first country in G7 going to raise rates next year. Bank of Canada feel the inflation is coming. Yellen knows it. This was a turning signal and also triggered the market's decline at that time. But is it what the markets think? Let's look at this chart. The market do not expect a rate hike. It's just an excuse for market correction. Let's compare the IWM to QQQ ratio and the 10-year treasuries and 2 years yield difference. As you can see, the Russell 2000 value ETF IWM is stronger than the Nasdaq QQQ. When the 10 years treasuries and the 2 years Treasury's difference increased these few months. Look at those growth stocks last year, like Net, Pins, NIO, Tesla, all drop like there is no tomorrow. They are not the market favorite. Let's look at the advanced decline rate zone. Most of the decline happened in the Nasdaq as well. However, the global minimum tax rates that Yellen talked about will affect those companies that have international business. So, which sector is the market's favorite? As the interest rates increase, banks can earn more from the difference between the long year-term rate and the short-term rate. Bank stock like Goldman Sachs, HSBC, and Wells Fargo's WFC will benefit, but if there is a little pullback, as inflation coming, commodities like lumber, corn, wheat, can, and oil all of them increase as well. Corn and lumber is the favorite. For lumber stock, since lots of people moving to small town, there are tons of demand of housing. A lot of lumber is required. WFG is trying to break out. You can see that. This is a buy now. For asset manager like LPLA, is trying to break out again too. For home building stock, ETF, ITB, and XHB, both of them are strong. Look at WSM. It's trying to break out again. For construction stock, J, look at the weekly chart. It's already break the all-time high. JCI also break the all-time high. Both of them are strong. For steel stock like CLF, and X, both of them trying to break out too. Since agricultural production price is increasing, fertilizer is also strong. Let's look at MOS. After earning, it still hold at high price. NTR and BG are all trying to break to new high as well. Let's look at CF. It's just break out from a cup and handle pattern. It's a buy at 51.16. For those people who want to buy gold sector, it's building a higher high and a higher low. It's ready to increase more, so it's a buy too. In the consumer sector, for clothing, let's look at ANF. ANF, see, is trying to break out as well. For URBN, Urban Outfitters, it's a low shade. It's trying to break out as well. Both of them are buy now. So what do you guys feel? Leave your comments below about which ETF or stocks you like to hear. Remember to like, share and subscribe this channel. See you next video.